Good afternoon, sir. My name is Bibek Karmacharya. My London Met ID is 230571156 and my college ID is NP01MB7S240033. Today I will be presenting the investment appraisal report for Bremont Watch Company Limited. This presentation will cover the expansion into the smartwatch market, including the financial analysis and recommendation. Here is the agenda for today's presentation. We will start with an executive summary followed by an introduction to the company. Then we will dive into the projected cash flow, expansion of cost of capital, WACC calculation, NPV, NPV calculation. We will also discuss the evaluation of capital investment appraisal technique, funding option, and conclude with our recommendation. To begin our presentation overview, focus on Bremont's expansion into the smartwatch market, requiring an initial investment of 10 million. We expect positive cash inflows by year 5, overcoming initial cost. The financial highlights include a WACC of 8.89% and a positive NPV of 4.4 million at this rate, with a payback period within 5 years. Based on these metrics, we recommend proceeding with the project to support strategic growth and innovation. Slide number 5, the company introduction. Bremont Watch Company Limited specializes in luxury aviation themed timepieces known for high quality craftsmanship and durability. As part of its mission to blend traditional watchmaking with cutting edge technology, Bremont is now expanding into the smartwatch market to align with modern market trends and innovation goals. As you can see, the slide number 6, projected cash flow. Here is the appendix and the figure of the slide shows the projected cash flow over the next 5 years, starting with an initial investment of 10 million in year 0. We project sales quantity and price per unit, leading to total sales revenue after deducting fixed and variable cost, advertisement cost, and supervisor salaries and depreciation. We calculate the profit before and after tax, including depreciation and accounting for cash outflow and opportunity cost. The net projected cash flow shows the positive trends from year 1 onwards. As you can see, this slide number 7, calculation of WACC. Here we calculate WACC with a cost of equity of 8.57% and cost of debt at 9.47%. The WACC is determined by 8.89%. This is derived by weighting these costs according to their respective proportion in the company capital structure. A lower WACC encourages more investment projects due to reduced financial risk. Explanation of cost of capital. The WACC of capital, or the weighted average of cost of capital, or WACC, is crucially in investment appraisal. It represents the minimum return a company must earn on its investment to satisfy both creditor and shareholders. This metrics guide investment decision, ensuring they are cost effective and meet stakeholders expecting by comparing accepted returns against the WACC. And you can see the WACC evaluation. The historic WACC was 22%. Higher cost of capital restricting project feasibility to only high return ventures, promoted caution financial strategy due to increased risks and expenses. New WACC is 8.89%, which is lower cost of capital, enabling more projects to be financially viable, encouraging investment in new and diverse projects due to reduced financial risk. Impact of change in WACC. Improves business flexibility and potential for growth by lowering the financial threshold for project approval. Increase the company market value, reflecting better risk assessment and financial health. I would like to recommend that capitalize on lower WACC to expand and diversify operation more cost efficiently and effectively. Now the next slide is calculation of net present value and PPV using the WACC. When using a WACC of 8.89%, the present value NPV of the projected is positive at 411,302, and this indicates that the project will generate return above the cost of capital, signaling profitability. The payback period, or PPV, is 4 years and 9 months, which is within the reasonable time frame and supporting the financial prudence of this investment. And the decision is that based on strong NPV and acceptable payback time period, affecting the project financial viability. Calculation of NPV and PPV using cost of capital of 22%. Alternatively, using a higher cost of capital 22%, the NPV turns negative. Additionally, the payback period exceeds 5 years, indicating that the initial investment isn't recovered within the project expected lifespan. Based on this matrix, the project will be rejected due to unprofitability and higher risk. Calculation of payback period. Its analysis indicates that the investment plan utilizing the historic weighted average cost of capital WACC of 22% yet at a payback period exceeding 5 years. The investment within the historical WACC is deemed unfeasible due to the extended payback period. It is recommended to proceed with the revised investment plan, which offers a payback period of 4 years and 9 months. This decision is justified by the opportunity of the investor. The revised plan ensures a more practical and viable investment strategy. Critical evaluation of 4 main capital investment appraisal techniques. In evaluating capital investment project, we use our 4 main techniques: NPV, internal rate of return, payback period, and accounting rate of return. NPV assess profitability by discounting future cash flow. IRR calculates the rate of return at which NPV equals 0. The payback period measures the time to recover the initial investment, and the accounting rate of return evaluates profitability relative to accounting profits. And here is the pros and cons of all these 4 terms. Critical explanation of different forms of funding for companies. There are different sources of funding like equity financing involving selling ownership stake but dilutes control. Debt financing requires borrowing funds, maintaining ownership but with regular repayment obligation. Venture capital provides expertise and capital but demands high returns. Angel investment offers mentorship with potential equity demands. Crowdfunding raises funds from many individuals and require effective marketing. Bootstrapping involving self-funding, maintaining control but limiting scalability. To summarize, the financial analysis shows a positive NPV of 411302 at a WACC of 8.89% with a payback period under 5 years, indicating the project viability. Strategically, the project aligns with Bremen's innovation and market expansion goals. We recommend capitalizing on this favorable financial condition to support growth and innovation in smartwatch market. And you can see the appendix of cash flow statement, WACC calculation, historical cost at 22% as per WACC 8.89%,